are. So let me go to the lobby. Morning, Chris. Morning, Derek. Peter's been on for a while. Morning, Padraig. Good to see you. Morning, Stephen. Thanks for joining. Appreciate that. Morning, Lisa. Great to see you. Let's bring a few other people in. Morning, David.
Good morning, Steve.
Morning, Rosalind. Good to see you. Good to see you. Thanks for joining. If you've just joined, if you could mute, please, that would be good. Lisa, if you could mute, that would be great. And David, yeah, you muted as well. That's good. Excellent. Let's bring John Quinlan in. There we go. Morning, JQ. Morning, Philip. Good to see you. If you've just joined, if you could mute, please, that would be great. Let me just. Okay. Morning. And morning. There's two Peters. Morning, Peter. Morning, Peter. So I think, yeah, it's now 10:32. Graham and Laura, I will monitor the lobby as suggested. Yeah, we'll get started. I think we'll get started. So good morning, everybody. Welcome to this week's Pension Playpen Coffee Morning. We're delighted to have Laura McLaren and Graham Jones from Hymans talking about the wonderful world of the funding code. And we can also sort of spin in the run-on debate as well, and how all these approaches impact funding. As usual, we are recording, so can we have a thumbs up from everybody that are happy to record? Derek, you're happy? Graham and Laura are obviously happy. I can't see some of you, but I'm assuming you're happy. Thanks for the virtual hands as well, David. That's very kind. As usual as well, yeah, if you'd like to ask a question, please raise a hand as we go through. We like to keep it informal and interactive. I will also open up the chat room. So if you want to put any questions in the chat room, please do. However, as you know, we will drag you from the chat room to the real world. So there we go. Without any further ado, and thank you in advance, Laura and Graham, for your presentation. I will pass you on, and thank you very much indeed in advance for your presentation. So look forward to it. Over to you.
Great, thanks, Steve. Yeah, thanks a lot for having us this morning. Hopefully, it's sort of obvious who's Laura and who's Graham, but I'm Laura McLaren. I'm a partner and scheme actuary at Hymans Robertson, and I've been really involved in sort of our response to the funding code, both sort of through the various consultations and in terms of sort of advising initial clients. Graham, do you want to introduce yourself?
Yeah, no, sure. No, thanks for having us, everyone. Yeah, I'm Graham Jones. Scheme actuary at Hymans Robertson. Been with Hymans for 15 years now. Yeah, most of my time spent advising trustees, do a little bit of company advice as well. But yeah, spent quite a lot of time, as you can imagine. Yeah, sort of on the development of the sort of funding code and what that's meant for clients over the past few years. And yeah, I guess in more recent times, been working on run-on and what that looks like, and yeah, we'll get on to that a little bit, both from yeah, what we see the sort of development of the funding code looking like from a sort of run-on perspective, but looking forward to yeah, to speak to you all today.
Great, thanks, Graham. Okay, so we have prepared a little bit of content, and this is a sort of broad running order for this morning. So I'm going to sort of kick stuff off with a little bit on sort of the backdrop for 2025 valuations. Steve gave a bit of a flavour for that in his introduction. We'll do a little bit on the funding code, just a bit of a recap of kind of key points. Then we'll kind of look at sort of what the impact of the code might be on schemes and sort of some potential consequences, sort of interesting themes that we might see coming through for 2025 valuations. And then Graham's going to sort of dig into more sort of funding code run-on and sort of that broader policy landscape and what that means. We've got a couple of sort of natural breakpoints for some questions, discussions, but please do sort of use the chat as we go through and sort of happy to try and keep it informal and pick up those questions as we go. So kicking things off then, backdrop for 2025 valuations, what are some of the key things that are feeding into that? Well, firstly, after many many years in gestation, we finally got the funding and investment regulations and the regulators' new code all laid before Parliament last year, plus sort of some of the accompanying sort of covenant guidance landing at the end of the year. And so now we sort of have that new framework, and that was all effective for valuations after 22nd of September 24. So there are some valuations probably at 30th September last year and 31st of December, but certainly a lot of valuations that will be coming up as at 31st of March this year. So I'm going to, when we're talking about 2025 valuations, I guess we're probably including some of those September, December valuations in the mix too, sort of thinking about kind of valuations that will be on the go this year, but all of those being the first to kind of go through this new funding regime. Wider backdrop, I guess the fact that actually a lot of those schemes will be going into valuations from a position of improved scheme funding. So certainly over the last few years, as we've sort of seen gilt yields rise, that has generally had a positive improvement combined with sort of growth returns and factors like longevity. Actually, a lot of schemes are in a better funded position than they were at previous valuation cycles. And we've definitely seen that sort of manifesting in a move away from thinking about necessarily funding sort of technical provisions, sort of ongoing funding deficits, towards much more sort of long-term plans, endgame planning, and thinking about kind of what that sort of ultimate plan for the scheme is. So a lot less about sort of cash negotiations and perhaps much more around that kind of long-term planning. And of course, we've got kind of this general shift in industry and policy thinking that is stimulating more debate around endgames and run-on. We had the sort of Mansion House proposals kicking off in sort of 2023, and then last year's sort of options for DB consultation. And of course, in the last couple of weeks, we've had the government announcing that they are going to publish a response to that consultation in spring 2025, setting out some proposals that will be sort of more supportive of making it easier to share surplus in schemes, so potentially more supportive to that run-on discussion. So I think those are all sort of the key factors that we're likely to see kind of providing the backdrop to funding discussions this year. If we start a little bit with the codes, because this clearly will be quite a big change in terms of it. It's the sort of biggest change to the scheme funding regulations in sort of 20 years since the sort of scheme specific funding regime came into place. Most schemes, will now need to sort of wrangle with actually what does the code require and how do we satisfy compliance. So in a nutshell, and the key component of that is that trustees will need to set this low dependency objective for significant maturity. That'll need to be sort of prudent enough so that if they're fully funded on that low dependency basis and invested in a highly resilient and sufficiently liquid low dependency investment allocation, then really the premise is that there shouldn't be a lot of reliance on the sponsor. So you should be in a sort of position where you're not necessarily expecting the sponsor to need to make any more contributions under reasonable circumstances. The little flowchart in the middle is sort of trying to just capture the sort of practicalities around that. So sort of initially saying, actually, the starting point is to think a bit about actually what that long-term objective is. So more a sort of end game objective. Is it buyout? Is it to run on? Is it sort of something else like a super fund or consolidator? Then you need to translate that into actually, okay, so what, sort of with that end game in mind, what's a sensible low dependency position? Think about sort of target investments that you would want to be holding by the relevant date, and derive a funding basis that's consistent with that investment allocation, and then think about a journey plan. So think about how you'll move from a current funding position to that low dependency position, such that you've got a plan that's linked to scheme maturity and covenant reliability. So the general expectation, whilst the code doesn't sort of codify what that journey plan should look like, it requires that the plan, it has a sort of general expectation that you will be sort of de-risking as the scheme matures and as the covenant becomes less certain. So the first sort of at the high level, it's set long-term plans, and then I guess the practical piece is about sort of aligning the valuations to integrate those long-term plans. So setting technical provisions in a way that's sort of consistent with that low dependency objective, some specific requirements around recovering any deficits on that technical provisions basis as soon as the sponsor can reasonably afford. And then you've got, quite importantly, some new reporting to the regulator through the statement of strategy with what they call fast track or bespoke routes to compliance. So fast track offering a kind of streamlined route to complying with the regulations, such that if you can satisfy prescribed tests, the regulator says, actually, yeah, we'll be pretty comfortable that your valuation complies, and we're unlikely to scrutinise it any further. Or alternatively, you can go down a sort of more bespoke route where actually you can come at things in a much more scheme-specific way, but actually there's going to be more sort of onus and requirement to evidence and justify how you've complied with the principles of the code. So both those routes to compliance sort of equally valid, just sort of a slight difference in terms of sort of governance and probably advisory cost associated with either route. Thought it was helpful to probably just sort of dig into the fast track a little bit further, because that is a sort of helpful reference, sort of frame of reference, in the sense that it is a bit more codified in terms of how the regulator sees sort of fast track compliance as being compliant with the principles of the code. So under fast track, the requirement is that you would be funded to a gilts plus a half basis by the time the scheme is significantly mature. And that is defined in the code as being when the scheme's duration is 10 years. There are some assumptions that are sort of specified in that low dependency basis, and actually generally there's an expectation that you would also have a reserve for expenses in that low dependency objective. As I've said, kind of technical provisions are then expected to sort of converge to that low dependency objective as the scheme matures. So you can see from the sort of picture that what fast track sets out is that at a 22-year duration, you'd expect technical provisions to be around 83.5% of the low dependency objective, and those increase all the way up to sort of 100% by the time that duration is 10 years. There are then some specific tests around recovery plans. So under the code, if you have got a deficit on that technical provisions basis, recovery plans shouldn't be any longer than 6 years, generally, unless sort of you're at the point of significant maturity, and then that 6 years actually reduces down to 3 years. You're not allowed to allow for any sort of extra investment outperformance in that recovery plan, so you're sort of only assuming that returns are sort of consistent with that unwinding of investment returns in your technical provisions basis, and it prohibits any sort of back-end loading, so you can't sort of back-end loads contribution schedules. They can only increase with sort of inflation or sort of some sort of fixed 3% increase. And then finally, there's some limits around investment risk. So that's sort of with reference to a PPF stress test, looks at a sort of 1 year, 1 in 6 VAR change in funding level, and again sets some limits around that. It's quite probably fair to say it's quite a crude measure of investment risk through that stress test, and actually what we see when we sort of look at that for specific schemes is that it is relatively easy to pass that test for schemes that have pretty high hedging in place, even if you do have a reasonable exposure to growth. I think under the fast track, TPR have sort of set out an illustrative sort of notional strategy that sits behind the fast track test at significant maturity, and that has sort of about 15% allocation to growth and about 90% kind of inflation and interest rate hedging. But if you work that back to kind of earlier durations, that percentage of growth that's permitted will sort of increase. And as I say, just sort of depending on the amount of leverage and stuff you're running, actually there is quite a lot of flexibility to pass that fast track test.
Okay, Laura,
I have seen some questions.
Yeah, you go.
No, that's okay. I haven't had a chance to read them all as they came through, but I could see different things popping up. let's see.
Yeah, so this is from Peter Cameron Brown.
Yeah.
He's put some stats in there. Gits plus a half. I love the Gits plus a half. That could is moving towards a low dependency objective using these measures really reducing risk?
Big question. If we zoom a 20-year.
Yeah, that was because I used I had the figures for 20-year gilts to hand. So.
Okay.
But it's probably not unrealistic for some of the closed schemes if you think about the profile of membership.
Yeah, so I suppose you're questioning the sort of using a gilts plus as a reference point there in the sort of basis, and yeah, whether actually that is low enough.
And the fact that you're using a single point measure, i.e. the gilt yield at the valuation date. In all the other things where actuaries are involved, they analyse the history of multiple events in the past and try to come forward for a prediction for the future. But in the valuations, they use one single measure, a historic measure, for the point for all the future. So,
yeah, I mean, I guess in terms of the sort of gilts plus a half reference, I mean that there is scope for that to be reviewed over time. But I think gilts plus a half is sort of what we have now to work with in terms of plans.
A gilts plus a half now is 5.63, but if you did your valuation at 1.72 and you required an awful lot more assets. Now, my concern is that, well, as Con Keating has pointed out, the TPR is overestimating the assets available in pension schemes substantially. And saying, oh, it's all right, they're in surplus. In fact, the most critical thing for a mature pension scheme is the actual realisable capital value of its assets, because they're going to have to sell them to pay the pensions. Also, if they are going to risk transfer and do bulk purchase annuities, it's the maximum cash that's available to purchase those annuities, reduces the demand on the employer for additional contributions. So,
yeah, I mean, fair points, yeah.
So yes, sorry, it was, I didn't really intend to put it up quite so early. I hit the screen accidentally, and yes, the gilts was a finger problem, the gits, but yes, perhaps that sort of thing. So yes, I really think we have, we're creating a new crisis by encouraging schemes to follow a fast track process without actually thinking about what their cash flows are and actually doing the cash flow work to work out how much of their assets they've got to sell in the first year to pay the pensions and so on.
Yeah, I mean, I think that's a really key point actually, is that sort of just following fast track doesn't sort of mean compliant or good. Like fast track is quite a blunt tool that the regulators published, and I do think some herding to that is probably inevitable, because the minute you sort of do publish something that the regulators sort of saying, well, we won't kind of scrutinise, you see the attractiveness for schemes to sort of gravitate towards that. So yeah, I think I would definitely agree that actually most schemes should be thinking more about the fundamentals of strategy and risk, and shaping strategy with that in mind. And sort of the fast track should be a kind of downstream piece around that. That's more about compliance and sort of showing that you've got something that complies, but it shouldn't drive the strategy up front. Yeah.
Rather cynically, I suggested that schemes that are following the fast track route must justify why they think it is appropriate to their scheme in their submission to the regulator.
Yeah.
So there. Anyway, that was my point. I'll let somebody else get to and let you carry on.
Okay. Thanks for that. We've got the hand raised from Rosalind Connor. Rosalind, do you want to unmute?
Yeah, sorry. I think to say that actually I was disagreeing with sort of Laura's position on this, and the point being made. I think there is a real risk that people think that if I do fast track, I am somehow compliant with my legal obligations. And you're absolutely right, Laura. All that fast track does is say the regulator isn't going to be out to get you, or it's not going to be looking. And we get why the regulator's doing this, right? They've got thousands of schemes and they need to focus on the few. And they haven't really done a terribly good job of that, I'd say, historically. I suspect because they were spread too thin. And they're doing this partly to say, well, here's a whole bunch of schemes we're not going to look at. But I mean, I think, coming back to the point was being discussed earlier and to the points that Peter was making and Laura's points, I just think we all need to be aware that we've got to do this. Of course we do, because it's what the legislation requires us to do. But the legislation doesn't make the trustees free of risk if they follow fast track. They herd towards fast track. They don't really think whether they want to do it or not. They just go and do it. Then there's a problem in the funding of the scheme. And members are going to turn around and say, well, you didn't, you should have thought of that differently. And they're not going to have a great defence of just saying, well, fast track was easier for me, or I was following regulatory guidance, because that doesn't get you out of trouble. And that's not to say we don't need to do this. And I'm finding this really helpful because I don't really understand a lot of it. But I just thought I'd flag that. I think it's a really good point.
Yeah, thanks, Rosalind. Yeah, really, really helpful. So maybe we'll keep going through, because actually, yeah, I think this is sort of starting to get into some of the sort of potential consequences and implications. But before we sort of, point was just a little bit around sort of the current UK DB landscape. So sort of thinking, actually, this is what the code requires. I mentioned up front that sort of the current landscape is pretty well improved. So probably is a question around like how much impact is the code going to have? The chart on the left hand side, I sort of won't get into this too much, and it's with a little bit of trepidation that I put up some of TPR's numbers given some of the comments so far. But on the left hand side, most of that chart comes from sort of actual valuation submissions that TPR receives for the different sort of valuation tranches, with a couple of years of more recent data coming from the stats that they've published. And really just that the key takeaway is just the improved funding position that you can see from sort of the inception of the scheme-specific funding regime, where maybe sort of 15% of schemes were reporting that they had a technical provision surplus. Now, if you sort of roll that forward, actually we're saying less than 20% have a TP funding deficit to worry about. And we see sort of average technical provisions and buyout funding up around the 100%. We can obviously debate a little bit around the sort of precise numbers, and but I think the broad point that schemes are in a much stronger position feels correct, and certainly sort of true in terms of the schemes that we're that Graham and I advise, in terms of them being much better funded than they were historically. And then on the right hand side was just sort of to draw, I suppose, a couple of similar sort of stats around valuation submissions, particularly with relevance just to that fast track framework that I mentioned on the previous page. So the green bars are just sort of showing the sort of median recovery plan reported in these valuation submissions. So this is sort of actual historic valuations up to around sort of 2022. And again, you see quite a sharp fall from sort of up around sort of 10 years to recover deficits on average, down to actually sort of less than 4 years in that median. And when sort of TPR take the submissions and they sort of derive what they would call a sort of single equivalent discount rate through that sort of gilts plus lens, as a way to sort of compare funding plans across schemes, then actually you do see that a lot of schemes, their technical provisions have actually converged to a strength that is not very far away from that gilts plus a half. So I think all of that sort of points back to, yeah, like the code is, it is coming into an environment that is much improved to probably what was first, envisaged when the proposals were first put on the table. That fast track basis that we've looked at actually is within reach for a lot of schemes to do. And I think, potentially that does sort of necessarily heightens the risk, but it certainly does mean that it probably becomes quite an attractive route to go down, and we do risk, you know, what Rosalind and I were speaking about, which is that sort of falling into that as a bit of compliance without sort of actually taking the time to step back and work through strategy. So yeah, I guess I sort of hinted at sort of, you know, how much of an impact is the code going to have. I think in a lot of cases, as you know, we're saying schemes are kind of well funded. Actually, they might be sort of fairly close to what the code requires, or actually still likely to have quite a lot of time to shape strategies. So if they still are relatively immature, they've got a bit of time to get to a low dependency objective, and that probably gives them some pretty good levers to play with. There probably is a bit more flexibility than you think. So certainly if you kind of go back to the original sort of draft proposals, they were more rigid in terms of some of the constraints around particularly investment risk. So sort of the original drafts had sort of set out that investments had to be both highly resilient and broadly matched. And there was a strong pushback from industry that actually that was very much going to sort of herd schemes to need to invest in gilts and would require, you know, quite a low risk strategy. In the final regime, that broadly matched requirement has been dropped. So we still have a requirement to be sort of highly resilient to market conditions and to be sufficiently liquid to meet benefit payments, but certainly more flexibility, much more flexibility for surplus as well. So it's much clearer that actually you can kind of do more with any surplus assets, and that certainly actually you're not required to stick with that gilts plus kind of discount rates. So sort of going down a route where you do have discount rates that support your investment strategies. So sort of CDI type strategies are probably the most common example, where you are kind of aligning your assets and your discounting more closely. All of that is still all possible within the framework. It might be a really good reason why actually you decide not to go down the sort of fast track route and do something that is more bespoke for a very good reason. I think I mentioned it probably when we were chatting it through, but bespoke, you know, is certainly as good a rate as fast track. So, you know, if you've got a strategy that doesn't meet fast track, actually, you know, it certainly shouldn't be daunted by going bespoke. It is there to accommodate scheme specifics, like, as I say, sort of dynamic discount rates, contingent assets, sort of atypical covenants, all of that, you know, the regime is there. In many ways, you might argue that sort of the bespoke regime is more similar to the sort of status quo, or what was the status quo, scheme specific funding, and that all valuations were sort of historically in that bespoke route. I certainly, you know, I kind of take the view, if you were getting comfortable with a funding plan that you've agreed and signed off at previous valuations, then I don't think the code should be a reason to go and rip that up. If you've had good advice and taking good decisions, there should be a way of being able to sort of justify that those plans look sensible through the lens of the code. But, you know, I think all of that sort of good news, you know, actually you're not necessarily going to need to sort of wholesale go away and change your plans, but I think it will have more of an impact at certain in certain pockets. I think small schemes, it's going to be more onerous for them potentially to meet the new requirements, perhaps more of a gap between what they've done at previous valuations and the advice that they'll need to take to comply with the code. I think schemes that are at the much more mature end, I guess sort of time frames to get to that low dependency position will be shorter. So potentially if they are further away from that low dependency position, that will kind of create a bit of pressure for schemes that are mature. And, you know, I've spoke a lot about kind of the majority of the funding landscape is in quite a strong, well-funded position, but there is still this sort of minority of underfunded schemes. We're sort of saying kind of the 20% or less that do still have a deficit through a sort of ongoing funding measure. And certainly I think that is likely to be tougher. There's definitely more things to think about, more likelihood that you are going to need to think a bit harder on plans. And, you know, I think as we'll sort of come into sort of the compliance aspect for all schemes is probably the big thing that's changed. So even if you can sort of map your plans across fairly easily, there's going to be lots of new guidance and principles and compliance for everyone to get to grips with. I think I saw a hand pop up there.
Yeah, we got a hand
Chris?
from Chris. Chris, do you want to unmute?
Thanks. Yeah, thanks. That's awesome. Awesome description. I was just wondering. We work with a number of small schemes, and the expense allowance is potentially quite a big thing for them. But also, if they're getting close to buy-in, they're de-risking and investing in a lot of gilts and corporate bonds. Given the sort of move in markets, are you seeing anyone kind of think that gilts plus a half they can't really justify based on their investment strategy kind of going forward, or is everyone just sort of going gilts plus half, that'll be fine?
Yeah, it's interesting with the sort of spread difference. I think for most, gilts plus a half is still sort of an achievable, right, as a target. I haven't seen a huge sort of pivot away. Definitely some interesting discussions around sort of if you are thinking about buyout and insurer pricing and that being kind of an end goal, what the best strategies to sort of match some of that might be. And I think historically, yeah, sort of heavier sort of credit-based strategies where the thinking sort of convalesced around, and definitely seeing more questioning of actually, now that sort of credit exposure is likely to be a bit less. I think the fact that a lot of schemes are better funded is helping probably alleviate a bit of that risk. So you're not sort of having to take a lot of investment risk to get to that gilts plus a half. It's more about sort of being able to sort of stay where you are. So I think that sort of helps a bit on probably the return front, if I'm honest.
Cool, thanks.
Okay, so maybe this is kind of an interesting slide. So I think it's a bit of build up in terms of like what the code is, what it requires, sort of impact at a high level. But here, I guess I've sort of pulled out a summary of what I thought were some of the interesting sort of potential consequences. The first one I can sort of tick off. We've chatted a bit about that. So yeah, I guess there is this risk that we do see a lot of schemes heading to fast track, and as we've sort of said, actually fast track doesn't necessarily equal compliance. So that definitely feels like a risk. I think linked to that, if I was a trustee, I think I would certainly be wary of sort of a pressure to potentially level down any plans, at least inappropriately so. And by that, I sort of mean, a sponsor saying, well, actually, the regulator says all we need to do is this fast track basis, and sort of writes the trustees a letter that looks pretty similar to the one on the right-hand side. And it's sort of saying, well, actually, yeah, we've got a plan that was aiming higher, but let's just use fast track. And actually, that ends up with something worse off. Can certainly see some risk in certain circumstances that sort of dynamic plays out. The third one, the sort of, do we really want to write this down? I think is an interesting one. So in the sort of statement of strategy, the idea is that trustees and sponsors will sort of write down what the ultimate objective for the scheme is, and the sort of rationale for the low dependency targets that they've set. I think the reality of this is that sort of putting pen to paper, I've certainly had circumstances in the past where trustees and sponsors were sort of agreed that they would like to buy out, sort of once that was affordable, but there definitely would have been a lot of reticence to write that down in a way that felt like they would be compelled to fund that or fund it with any sort of timescale. So I think inevitably with that sort of compliance, what you potentially risk is that you sort of end up with plans that are written down for compliance purposes, and then there's the sort of actual plans that are a bit beyond that and a bit separate, and you sort of end up with sort of compliance that layers up like that, a bit unhelpful, potentially a bit of sort of wrangling between the trustee and the sponsor around exactly what we want to write down. I think probably interesting as well, there'll be lots of sort of trustees and sponsors that might not have actually engaged much on some of that long-term planning stuff at previous valuations. So, you might have instances where actually the trustees had a pretty clear objective, but they hadn't necessarily tried to or managed to get that formalised with the employer. Some technical points, expense reserves, I think is a really interesting point for valuations. I think particularly in sort of small schemes, so the fact that most schemes will be expected to sort of add in an expense reserve at, so sort of that says once you get to low dependency, you've got a reserve there that will fund future expenses. The only exception being if the rules actually compel the employer to pay those expenses. That could be quite a material increase in liabilities for some small schemes and not necessarily something that schemes will have been building in. Employer covenants, generally more to think about and do versus what's been done at previous valuations, although at some scope to keep that proportionate, but certainly more sponsor input required. And for any schemes that have used contingent assets in the past, there's generally a much higher bar for those assets being sort of able to take into account. So if you sort of read through the guidance, certainly if you think about sort of parent company guarantees, the regulators sort of codified this sort of new gold standard look-through guarantee. And actually there will be a lot of sort of guarantees out there that won't necessarily meet the requirements of that look-through guarantee, which essentially sort of mirrors the obligations of a sort of full statutory employer. So yeah, we'd be kind of saying if you've got those sort of arrangements, you should be kind of digging them out and thinking about that pretty early on in valuation processes to see whether they're sort of going to qualify and how much you might be able to rely on them. Measuring risk, a lot of, particularly, a lot of this is sort of still principles based, still sort of concepts, the sort of no defined way of doing that in the code, or certainly scope to use a range of methods. So things like the 1 in 6 bar are options and sort of looking at what risk the employer can support. But again, yeah, certainly, that's going to be a key focus for a lot of schemes, particularly if you do want to do something, if you do want to sort of stretch that supportable risk a bit more, and we'll need some detailed covenant to sit behind that. Open schemes, I sort of mentioned, the code, sort of the final code sort of improves some of the provisions around open schemes, but I think certainly if schemes are still sort of open to new entrants and new accrual, there will need to be quite a lot of new thought about what those allowances are and how they're going to feed into things like the maturity of the scheme and the sort of projected positions. Much more onus, I guess, around thinking about the counterfactual of if you close tomorrow, how secure are accrued benefits. And I've mentioned the sort of, the additional statement of strategy compliance. I think that is the big thing that actually for a lot of schemes will be sort of extra time and cost going into that. And, although there is some scope to be proportionate, I think it will take quite a bit of time for that market practice to emerge. What you do need is probably some good advice to make sure that you are kind of spotting where there is scope to be proportionate. I think a little question just around expenses. Do we know if TPR are already including scheme expenses in their liability estimates? I suspect they're doing something in there, but it will be probably fairly crude. So what we might see is, sort of some impact on some of those headline surpluses reducing a bit once we see scheme expenses going in. I think, the sort of point around some smaller schemes facing an uplift of 15%, I think that very well could be fair at the sort of very small end. I think typically, as a rule of thumb, you often see that sort of small schemes, their ongoing expenses can be sort of 4 times plus a kind of larger scheme as a sort of proportion of assets. So the sort of actual proportionate uplift can be much more material at that smaller end. And no, I think on the sort of do we have to provide for future investment expenses, then no, I think that expense reserve more looks at the sort of admin side of costs. So you're not sort of double counting the sort of investment management and sort of investment return piece. So it is thinking more around the sort of expenses that will go through as admin expenses in your trustee reporting accounts. Yeah, so Rosalind, a good question around a big issue for employers on writing things into a statement of strategy might be that sort of auditors then look at that. So particularly, I think there's been this sort of concern if you say you're going to buy out, then auditors will take a view that that is the end game, and you start to kind of get caught with things like curtailment charges in the accounts. I guess we've not seen that yet. It probably is a bit early to see how some of that will play out, but I can definitely see that as being some nervousness around kind of writing that sort of thing down. Certainly, if you're in a position where you're thinking you might be sort of doing a buy-in, if you've got kind of something that says you are heading to buy out, then that's probably when you may be concerned. I think the reality is probably what goes in the statement of strategy will end up being something that is a bit more high level and doesn't necessarily in a lot of cases sort of set out a sort of codified plan beyond that low dependency piece, but might sort of articulate some sort of aspiration. But yeah, it'll be interesting to see where the auditors come out on some of that stuff.
Got a hand raised. Peter, do you want to just unmute and ask a question? Sorry, Laura.
Yeah,
Peter.
I was just asking for my benefit and perhaps for others. What's the issue with the curtailment charges? Is this possibly they're reflecting the fact that the company may have to reflect a significant charge to its profit and loss account when it?
Yeah, exactly. Yeah. So at the moment, what most companies will try and do is sort of avoid that charge when they've done a buy-in. But if the auditors can take a bit of a view, if a buy-in is seen as a step towards buyout, that you would start to incur those sort of curtailment charges. So I think Rosalind's point was if you start writing down that actually that is your end goal, whether that sort of helps, whether that causes the curtailment charge to come through.
Thank you.
Conscious of time, Graham, we've had lots of we've sort of done a lot on the codes and sort of potential consequences. It's maybe helpful for us to jump into the run-on stuff and think a little bit about the code in that lens.
Yeah, no, thanks, Laura, and for these questions. And yeah, as Laura said, just move through the next few slides, and yeah, look at how the code feeds into the run-on debate. And I think it's fair to say when the funding code was initially in development, run-on and sort of continuing your DB scheme was nowhere near as sort of front of mind as it is for many at the moment. And yeah, clearly we're seeing a lot of discussion from government and policy side around what the potential benefits of that could be for the sort of wider economy as well as members, and I think it's fair to say we are starting to have a lot more of those conversations with our clients at the moment, with that sort of lure of potentially being able to uplift member benefits, and from the company point of view, clearly accessing any surplus that that's been developed. So what the slide on the page is looking at is just sort of on the left hand side in very simple terms. What we've tried to do there is sort of set out a journey plan for a scheme that has opted to run on. Now a lot of detail that we're simplifying here, but effectively we've got a scheme here that's reached full funding, that's got a desire to push on to create a surplus. And firstly using that surplus to act as a buffer against some market volatilities, but then to go on to generate the surplus that would be shared with members and the company in some fashion. So loads of strategic decisions to be considered there, but what we're looking to illustrate here or sort of open the debate on is just the need within a run-on strategy to retain those growth assets to drive more of that surplus versus a much more sort of matched strategy that we were used to for schemes that are targeting buyout, and does that additional growth, those additional growth assets that would sit within a run-on strategy, can you get to a place where you satisfy some of those fast track requirements that we've touched on? And I think the sort of spoiler on this one is that we think you can do it. That said, we do very much expect that the code will develop, and that there will be almost a kind of part 2 of the code that will focus on surplus and use of surplus. But we'll come to that shortly. I suppose looking at this belief that you can set up a run-on strategy that could comply with the fast track code. So on the right hand side of the page, we've set out what we've called a typical run-on strategy. Now, lots of debate that could be had there, but we are. What the strategy would need to deliver to sit within fast track is these sort of highly resilient measures and the sufficiently liquid measurements. So Laura touched on this earlier, but it would be having downsides that are recoverable within 6 years. So that 1 in 6 VAR event should be recoverable from a funding perspective within 6 years, expecting those high levels of interest rate and inflation hedging, and also that sufficiently liquid requirement that cash flows can be generated to meet pensioner payments. So in the strategy we've set out, there is a mix of some equity and liquid assets to help grow that surplus over time, but also a mix of LDI and high quality credit to help meet that hedging requirement, and also providing the liquidity to meet members' payments, pension payments. We think that under that strategy, the 1 in 6 VAR event would probably be a drop in funding level of about 3.5%. Now, if we've set the low dependency target at gilts plus 0.5, but the strategy is delivering gilts plus 1.3, I think you could recover that 1 in 6 VAR event in about 4 to 5 years, within the 6 years that TPR, the fast track criteria sets out. So you would, under that quite crude measurement, be able to demonstrate that the strategy that you're adopting here hits that criteria, as well as the high levels of hedging and sufficiently liquid strategy. So that in isolation suggests that you can put together a strategy that fits within that fast track element of the funding code. But I guess the next question is, can you then go on and develop a surplus that is meaningful enough from a sponsor and member point of view to warrant putting that strategy into place? Or if you flip to the next slide. What we've done here is, so for an example scheme here, so £500 million in assets is already funded to 110% on buyout, so has built up this funding buffer, and it's been agreed that surplus can be distributed at that level, so at 110% of buyout, and that this scheme is running the investment strategy that we set out on the last slide. On our carried out some modelling of sort of thousands of scenarios and different outcomes, and what it's suggesting under those circumstances in this example is that over 11 years on our median outcome, that a surplus of about £100 million could be generated and then distributed to the sponsor and to members. So that's £100 million over 11 years for this £500 million scheme. So lots sitting behind that. Lots of detailed strategy discussions on when is right to distribute surplus, what the right strategy is, but intended to give an illustration that a pretty healthy surplus could be distributed using that strategy that sits within Fast Track. I guess what we do fully expect is that the funding code will develop, and as I say, a lot of conversation at the moment around what the future for run on and surplus sharing looks like, conscious of time here, but how I kind of see things is that the existing code is there to always kind of look after those schemes that have not reached the low dependency funding levels, that gilts plus a half. But what we expect to see, and that's what's at the top right hand side of this slide, is that code to develop, and actually the introduction of a DB surplus code that we expect will look at a number of things. So at what level can surplus be released? Clearly from a trustee point of view, there is a nervousness around, once assets leave the scheme, it's gone, and the risk that they then run, that they see some adverse market conditions, and then scheme funding falls. So actually most of the conversations we've had at the moment are suggesting that trustees like the idea of retaining the ability to buy out, so are therefore looking to still target buyout level funding, and then potentially with a margin on top of that before they let surplus go. But all that said, I think some will view that as potentially being a very prudent bar before surplus is released. I guess the TP measurements, technical provisions measurements, have prudence in it. The low dependency threshold again is more cautious. So perhaps setting margins beyond that before surplus can be released will be too far. I know I picked up some thoughts earlier just on surpluses being used to provide contribution holidays in cases where schemes have a future accrual, so that's something that exists already. It's using surplus in a slightly different way, but actually many trustees have got comfortable with allowing surplus to be used to subsidise accrual already, and at lower levels than beyond buyout. Conscious of time, a lot of there's certainly plenty of debate we could have in there. I think there's certainly a lot of thinking out there on what would be enough to encourage trustees to perhaps get comfortable with letting surplus go earlier. There's been discussion around a higher level of PPF underpin. I think initial reactions to that were just trying to understand the cost of that, and questions over whether it really looked worth it to have that kind of desired consequence. We've also got the emergence of super funds. So Clara's out there at the moment. There will potentially be new entrants to that market, but they provide access to the buyout market at a lower level of funding, provided you can meet the other requirements there. So there's a strong requirement about the covenant strength, and allowing for being sufficiently weak to allow entry there, but may what a super fund can provide encourage trustees to let the surplus go slightly earlier. In terms of sort of flexibility that might come in the regulations, a lot of discussion around how surplus might be used. So yeah, to sort of to go directly back to the employer, but also to be used for DC schemes. And to fund their employer's DC scheme. At the moment, it can be arranged if the DC scheme sits within the same trust, but not if the DC scheme has been moved into the master trust world. I guess there are further policy pushes to that seem to encourage and favour more use of master trusts. So you could see a potential alignment of interest there that open up that path for DB surpluses to be sort of passed into an employer's master trust arrangement. So yeah.
Right, we've got a quick query from JQ. I don't know if JQ you want to unmute, but on the question of surpluses, do you want to talk about that? Oh, okay, go for it. Go for it.
I had one comment on the earlier piece, actually, if you don't mind, which is it's kind of crazy that an asset-derived discount rate, I don't know why it's called CDI, I know, well, I get why, but an asset-derived discount rate is outside the fast-track lane, when a non-asset-derived discount rate is fast-track. It doesn't make sense. So when you look at it from a liability ALM perspective, where you've got some matching going on, to have something which is fundamentally reflecting your asset yield and the cash flows to be outside fast track. That's my comment there. And the question
I think that's just a pure compliance
I
TPR filter thing. Yeah, I mean, I would hope that they would see that if that's the only thing that's sort of different, or only thing that they would sort of mark as outside. You would hope that you would get a sort of relatively streamlined, bespoke approach. But yeah.
And the question of the surplus was just really just technical. Was the 110 million on the previous slide over and above the original 50, or was it in addition?
Yes, that is over and above that additional 50. Okay. Yeah, one of our big assumptions in there is that surplus in this case would be released at 110% of buyout. Now, that's not necessarily a view of what's right, but yeah, that's how we set that one. Yeah. Conscious of time, folks, and there is plenty more we could say in sort of debate around.
We might have maybe pick up this session in a couple of weeks' time on run on. I mean, I don't want to rush run on because it's another option, isn't it? So, is everybody happy to keep going now? We might overrun by 5 minutes. Everybody's thumbs up because we could just do it now. I think thumbs up from JQ and a few others. So I just keep going. Yep, there's a few thumbs up. So let's just keep going. So
sure, no, it's super. So yeah, I think I mean I've said a couple of times here we've skimmed over a huge amount of detail around what decisions and beliefs need to be tested in order to make a call on whether run on is right for your scheme. And then if you do decide it's right for your scheme, the framework around what strategy do you use, at what level is surplus distributed, and what are your contingencies are super important. But yeah, we do think strongly that your decision on whether to run on is going to be based on trustee views, sponsor views, and ultimate objectives and beliefs, and that the funding code itself shouldn't be the driver around that decision making process. So yeah, we've touched on some of this, but we've tried to boil it down to sort of 6 key items that we think trustees and sponsors should be thinking around. Can you do run on efficiently? How much surplus can be generated? I think what our feeling is that sort of an asset base of 250 million is probably going to be needed in order to make run on an attractive prospect. In terms of how risks are managed, I guess real careful consideration around around the downsides. Yes, there are some protections available already. So through the PPF, I guess discussion on could there be more? Super funds provide potentially a route to the buyout market at a less costly level than insurers at the moment. But running the pension scheme on then brings longevity risk much further up your sort of risk profile than it would have otherwise been if you were looking to buy out over the short term. So yes, some real thought and consideration around how you might hedge against that. Clearly from a member experience point of view, versus the insurance world, you're agreeing for the trustees to continue and oversee your membership for many years. So yeah, careful consideration there. And then the sponsor views. We've touched a little on accounting before, but yeah, having alignment is super important here between sponsors and trustees, and yeah, we would encourage engagement, joint working groups to to sort of reach agreement on whether run-on is where you want to go, but that continued engagement when strategy is set moving forward. Conscious there's lots of questions here which I've not kept up with.
I think there's a bit of debate, Graham, around just sort of DB accrual, and wouldn't it be good if if we could bring that back?
Yeah. I mean, I absolutely, and yeah, I think that's a comment around the level of scheme size that is able to make run-on work. Yeah, could many more could sort of enter that size range if DB accrual was reopened there. Yeah, clearly benefits for from an individual's perspective. I think that there's further debate to be had, and decisions for many trustees to make around the benefits of run-on, both from a member perspective and a sponsor perspective. But yeah, personal view is I think there's absolutely something to be explored there and a lot of benefit to be had. So yeah, it does feel with the right protections, the right level of risk management taken to any strategy that there's some real win-wins out there to be had. I'll pause there. See if there's any other questions.
I think there was an earlier question about surplus, but that's where a scheme is. I know one of our people have got, I think it's Peter's got over 200%, and it's an open scheme. Payment holidays, is that? I mean, I know people haven't mentioned payment holidays for donkey's years, but is that also an option?
Yeah, I mean, I think for schemes that have active members at the moment, we've seen, and I think it was Peter that put in the movement in gilt yields over the last sort of 4 or 5 years. We definitely have seen, effectively the level of sort of cost of future service accrual coming down, which has meant the contributions that have been paid have really sort of progressed funding levels. We are certainly having, we certainly have schemes that are having active conversations around contribution holidays, and I would almost view that as a way of using surplus to effectively pay for future service accrual. So I guess I've probably said here that we can talk about surpluses being paid back to sponsors sort of out of the scheme, but using your surplus to effectively meet ongoing future service accrual is a way of using surplus that exists already. I
guess, Graham, I suppose the point is there's just not that many schemes out there that still have future accrual. So there's a few more than that are fully open to new entrants, but it probably is still a reasonable sort of relative minority, isn't it, that have that DB accrual lever. which I guess takes us back a bit to sort of reopening DB accrual or being able to sort of fund DC or use it to sort of improve DC provision. Actually, the sort of contribution holiday piece is tricky if you've not got any accrual.
I agree fully with that. Yeah.
Okay.
One of the questions that came up last week, funnily enough, was also about, could you see a methodology where if people are investing in master trusts at the moment, they would reopen a DC section of an existing DB? And can you see the advantages of that? Is that something that could happen?
Graham, we were just discussing that.
Yeah.
Before we came onto the call. Yeah.
Great minds.
Yeah.
What do you think? What do you think?
Indeed. So I think we have seen that discussion being reopened, but it does. And when I say that discussion being opened, I mean this. Yeah, should we reopen a DC scheme that's in the same trust as a DB scheme? It feels sort of counter to some of the sort of wider policy discussions and sort of steers that are being given in the market, where the push is more in that opposite direction into master trusts, which would lead you to think that actually through this sort of surplus funding code and the consultation that is coming up, that actually opening this route to sort of paying surplus from a DB scheme to a master trust is going to be opened up, and the path to that potentially being cleared, that you could see some some consistency between some of the DB and DC policy. I think so that's yes, certainly something that I wouldn't be surprised to see, rather than that shift back the way.
Okay, well, thank you for that. I'm conscious of time. Any other burning questions? One question, of course, is there any chance we could have a copy of the slideshow? If anybody would like to see a copy, that'd be good. Laura, is that all right?
Yeah, that should be fine.
Great.
Yeah.
Okay. Are there any other questions before we? JQ, go on. You have the last one. Go on.
So this is a tad oblique, but in terms of the running on piece, and surplus, and I'm recognising that trustees generally are, like behavioural finance is going to say, that they are unlikely to want to see a refund directly back to employers if that brings the funding level below a buyout level. What do you think about the use of escrow accounts as a holding pattern for them? By that I mean, so in your case that you put up there, 50 million of the 500 million could go into an escrow account, so therefore it is in a holding pattern that might go back to the employer on the next valuation or the one thereafter.
No, I think that's as a kind of contingency, sort of downside protection is definitely something that could work here.
Yes, it's the reverse of the current contingent asset, or the historical contingent asset discussion has been about funding going into the scheme. I'm thinking about, yes, exactly that, the reverse of that, funding coming out and using a contingency vehicle where both parties are happy for a period of time.
I think I could definitely see how that would work, and some comfort.
I think there's lots of parallels with sort of capital backed vehicles and stuff. A lot of that is all about having that capital buffer outside schemes. So I think we will see escrows, maybe other vehicles that are sort of innovated for that sort of purpose. I mean, it makes a lot of sense.
Thank you.
Cool. Okay. I think at that point, I'm going to say very, very big thank you to you, Laura, and you, Graham, for your presentation. Hopefully lots of claps and virtual claps for everybody, and really, really good. Absolutely fantastic. Really appreciate that. And we'll post the video onto the Playpen site later this afternoon. And thanks everyone for joining. I hope you enjoyed the presentation. Really, really good. And and I will also do a podcast, I think, because there's a few younger people on here as well, and they can go to the gym and have a podcast as well. So there we go. Laura, you can be in the gym listening back to yourself. How about that?
I hope that means you're classing me as a younger person, Steve.
I am.
I'll take that on a Tuesday morning.
Yeah, take that on a Tuesday. So there we go. But listen, thanks so much indeed for your presentation. Really enjoyed it. Thanks very much indeed. Next week we are hearing from Michael Clark and Bobby Ridaway on trusteeship and their world. So hopefully you can join us next week. And as we usually say on these events, let's pray for peace in the East. We've got a ceasefire in the Middle East, but let's pray for peace in the East. And I wish everybody well for the rest of the day and for the rest of the week. And thanks again, Graham. Thanks again, Laura. Thanks very much indeed. All right, take care.
Thanks, folks.
Thanks a lot. Bye. Bye.
Bye.